When everyone is buying the same assets, it's time to think differently if you observe carefully. There's something deeply disturbing happening in today's financial markets that most people don't see. This isn't speculation. It's a mathematical certainty based on principles that have governed wealth preservation for centuries. Ray Dalio has consistently warned about the dangers of what he calls set concentration risk, the tendency of individuals and institutions to crowd into the same investments during periods of apparent stability, according to public interviews and his widely circulated research. This crowding behavior creates the exact conditions that lead to devastating wealth transfers. Macro investors argue that we are witnessing one of the most extreme examples of asset concentration in modern history. The majority of American retirement savings are concentrated in just three categories: U.S. stocks, U.S. bonds, and U.S. real estate, all denominated in the same currency, all dependent on the same monetary system, all vulnerable to the same systemic risks. This isn't a coincidence. It's the predictable result of decades of financial advice that treated diversification as spreading money across different stocks rather than different monetary systems. History teaches us that this approach works perfectly until it doesn't. The hidden mathematics of asset correlation. When Ray Dalio discusses correlation risk, he's referring to a phenomenon that most financial advisors don't fully understand. During periods of monetary stress, assets that normally move independently begin moving together. In 2008, we saw this clearly when stocks, real estate, and corporate bonds all fell simultaneously. But there's a deeper mathematical principle at work. Assets that depend on the same underlying system, the same currency, the same regulatory framework, the same central bank policies will eventually move together when that system faces fundamental pressure. According to widely discussed economic research, the correlation between all dollar-denominated assets approaches 1.0 during monetary crises. This means that traditional diversification becomes worthless exactly when you need it most. Consider the mathematics. If you have 60% stocks, 30% bonds, and 10% cash, you might think you're diversified. But from a monetary system perspective, you have 100% exposure to dollar-based assets. You're not diversified at all. You're concentrated, the signal hidden in plain sight, Ray. Dalio has often observed that markets signal major transitions long before they become obvious to the general public. One signal he's repeatedly highlighted is the behavior of real assets versus financial assets during periods of monetary expansion. In public presentations, Dalio has explained how physical assets, gold, silver, commodities, prime real estate begin outperforming paper assets when confidence in monetary policy starts to waver. This isn't because these assets become more valuable in absolute terms. It's because the monetary system they're measured against becomes less reliable. The data from 2025 tells a story that fits this pattern perfectly. While the S&P 500 struggled to maintain positive returns, precious metals experienced their best performance in decades. Silver rose 148%, gold climbed 65%, and industrial commodities showed consistent strength. Macroeconomists argue that this isn't a bull market in commodities. It's a subtle but accelerating loss of confidence in paper assets. When institutional investors begin questioning the long-term purchasing power of their cash reserves, they don't announce it publicly. They simply begin allocating differently. The wealth transfer mechanism, according to research often cited by global macro investors. Monetary transitions don't destroy wealth. They redistribute it. Those who understand the transition early position themselves to benefit. Those who don't get caught in what economists call the stability trap. The stability trap works like this. During periods of apparent monetary stability, people become increasingly comfortable concentrating their wealth in the assets that have performed best recently. This concentration makes them vulnerable to exactly the kind of systemic changes that stable periods inevitably produce. Ray Dalio has written extensively about how this pattern repeated throughout history. In the 1920s, American investors concentrated in stocks because they had performed exceptionally well. When monetary conditions changed in 1929, this concentration became devastating. In the 1970s, those who maintained traditional bond portfolios saw their purchasing power destroyed by inflation, while those who had diversified into real assets preserved and grew their wealth. The mathematical principle is consistent. Concentrated positions produce exceptional returns during trending periods but devastating losses during transitions. The institutional response. What makes the current environment particularly significant is how institutional investors are responding. Central bank gold purchases reached record levels in 2025. Sovereign wealth funds increased their allocations to real assets. Even traditional pension funds began exploring alternative investments. According to publicly available data from major institutional investment consultants, asset allocation models are being quietly revised. The traditional 60/40 stock-bond portfolio is being replaced by more complex structures that include precious metals, commodities, international currencies, and even cryptocurrency allocations. This institutional shift isn't happening because fund managers suddenly decided they like shiny metals. It's happening because sophisticated investors understand that maintaining 100% exposure to any single monetary system represents an unacceptable concentration risk. Ray Dalio has often emphasized that institutional investors move slowly and deliberately. When you see consistent patterns across multiple institutions, it signals a structural change in how smart money views risk. The education most people never receive. The challenge facing most Americans isn't lack of information, it's lack of framework. Financial education typically focuses on selecting investments within the existing system rather than protecting against systemic changes to the system itself. According to educational content widely distributed by macro investment firms, true wealth preservation requires understanding three distinct types of risk. Market risk, the risk that your chosen investments perform poorly relative to other investments in the same system. Currency risk, the risk that the entire monetary system loses purchasing power relative to real goods and services. System risk, the risk that the fundamental arrangements supporting your wealth preservation strategy become unreliable. Most financial education addresses only market risk. It teaches people to diversify across different stocks, different sectors, different geographic regions. But it doesn't teach protection against currency risk or system risk. This creates what macroeconomists call educated vulnerability. People who understand markets very well but do understand monetary systems at all. The alternative framework, Ray Dalio and other macro investors often discuss what they call all-weather asset allocation strategies designed to preserve purchasing power across different economic environments. The principle isn't to maximize returns in any specific scenario, but to maintain reasonable performance across all possible scenarios. Based on publicly available research from major hedge funds and institutional consultants, this approach typically includes productive assets 40 to 50%, stocks of companies that can maintain pricing power during inflationary periods, real estate and prime locations, infrastructure investments that generate income independent of monetary conditions, store of value assets 15 to 25%, physical precious metals, established cryptocurrencies with limited supply, foreign currencies from fiscally disciplined countries, hedge assets 10 to 20%, investments that perform well during deflationary periods, high-quality government bonds from stable countries, cash reserves for opportunistic investments, growth assets 15 to 25%, investments positioned to benefit from technological and demographic transitions, regardless of monetary conditions. The specific percentages matter less than the principle. No single category dominates, and each category responds differently to different monetary environments. The timing question. One question consistently raised in macro investment research is when to implement these strategies. Ray Dalio has often observed that the best time to prepare for storms is during periods of apparent calm. Historical analysis shows that monetary transitions typically happen faster than most people expect. The breakdown of Bretton Woods, the Latin American debt crisis, the Asian financial crisis, the 2008 financial system stress, all developed over months rather than years once they began, according to widely cited economic research. The problem with waiting for clear signals is that clear signals typically coincide with the early stages of the transition itself. By the time everyone sees the problem, the most effective protective positions have already become expensive. The mathematical advantage belongs to those who position appropriately during periods when protective assets still trade at reasonable valuations relative to mainstream assets. The implementation challenge. Macroeconomists often emphasize that understanding principles is different from implementing them effectively. Even sophisticated investors make predictable mistakes when attempting to diversify beyond traditional assets. Timing mistakes. Trying to time specific entry and exit points rather than building positions gradually over time. Concentration mistakes. Discovering that gold provides inflation protection and immediately putting 50% of assets into gold, recreating concentration risk in a different form. Complexity mistakes. Creating portfolios so complex that they become impossible to monitor or adjust appropriately. Cost mistakes. Ignoring transaction costs, storage costs, tax implications, and management fees that can eliminate the benefits of diversification. Liquidity mistakes. Creating positions that cannot be adjusted when circumstances change or opportunities arise. The solution, according to institutional best practices, is systematic implementation over extended periods rather than dramatic changes all at once. The global context. What makes the current environment particularly significant is the global nature of the monetary pressures. This isn't just about the US dollar or American fiscal policy. Similar patterns are visible across most major developed economies. According to data from international monetary organizations, debt-to-GDP ratios have reached historically elevated levels across Europe, Japan, and North America simultaneously. Central banks in all major economies expanded their monetary bases dramatically during the pandemic and have not fully reversed those expansions. Ray Dalio has frequently observed that when all major currencies face similar pressures simultaneously, traditional currency diversification becomes less effective. This is why modern institutional portfolios increasingly include non-currency assets like precious metals, commodities, and real estate. The global nature of current monetary pressures means that traditional flight to quality, strategies moving from weaker currencies to stronger currencies, may be less effective than moving from currency-dependent assets to real assets. The information asymmetry, perhaps the most important factor in current markets, is the information gap between institutional investors and individual investors. Institutional investors have access to research, analysis, and advisory services that individual investors never see, according to publicly available institutional research reports. Major hedge funds and family offices have been quietly adjusting their asset allocations for several years. These adjustments do unmake headlines because they happen gradually and are reported only in aggregate form with significant delays. But the pattern is consistent across multiple institutions: reduced exposure to traditional stocks and bonds, increased exposure to real assets, increased geographic and currency diversification, increased focus on assets that generate income independent of monetary conditions. Individual investors, meanwhile, continue receiving advice based on frameworks developed during the 1980s and 1990s. Frameworks that assumed monetary stability and consistent central bank policy effectiveness. The educational framework Ray Dalio has emphasized that effective investment education should focus on principles rather than specific predictions. The principle relevant to current conditions is that concentration in any single system creates vulnerability to changes in that system. This does not mean the US dollar is about to collapse, does not mean traditional assets will perform poorly. It means that maintaining 100% exposure to any single monetary system represents a risk that can be reduced through appropriate diversification. The educational framework that emerges from macro investment research focuses on three key concepts: optionality, maintaining multiple ways to preserve purchasing power rather than depending entirely on any single approach; adaptability, building portfolios that can be adjusted as conditions change rather than portfolios that depend on specific scenarios playing out as expected; sustainability, creating approaches that can be maintained over decades rather than strategies that require perfect timing or constant attention. The historical perspective. According to historical analysis often cited by institutional investors, every major monetary system eventually faces pressures that force fundamental changes. The gold standard Bretton Woods, the post-$1,971 system, all went through periods of stability, followed by periods of transition. The current dollar-based system has provided exceptional stability for over 50 years. But historical analysis suggests that this stability has allowed the accumulation of imbalances, fiscal deficits, monetary expansion, global debt levels that eventually require resolution. Ray Dalio has often observed that these transitions do not represent the end of the world or the collapse of civilization. They represent the normal evolution of monetary systems over time. Those who understand this evolution and prepare appropriately tend to benefit from it. The practical application for individual investors. This analysis suggests several practical considerations. Geographic diversification. Maintaining some assets in currencies and markets outside the United States reduces concentration risk without requiring predictions about which specific countries will outperform. Asset class diversification, including some exposure to assets that maintain value independent of any specific currency. Precious metals, real estate in prime locations, shares of companies with global operations and real assets. Time diversification. Building positions gradually, rather than making dramatic changes all at once, reduces the risk of poor timing. Liquidity management. Maintaining sufficient cash reserves to take advantage of opportunities while avoiding forced sales during market stress. Education investment. Developing understanding of monetary principles and economic cycles rather than just market analysis and investment selection. The risk management perspective. From a risk management standpoint, the question is not whether monetary transitions will happen. Historical analysis suggests they are inevitable over sufficient time periods. The question is whether your wealth preservation strategy can function effectively across different monetary environments. According to institutional risk management frameworks, this requires stress testing portfolios against multiple scenarios: continued monetary stability, gradual inflation acceleration, currency instability, technological disruption of traditional financial systems, geopolitical changes affecting international trade. All-weather concept by Ray Dalio emerged from exactly this type of analysis, building portfolios that perform reasonably well across multiple possible futures rather than betting on any specific future. The conclusion: when everyone is buying the same assets, it creates both opportunity and risk. The opportunity comes from reduced competition for alternative assets that may provide better diversification. The risk comes from the concentration of mainstream assets at exactly the moment when diversification becomes most important. This isn't a prediction that traditional assets will perform poorly. It's an observation that concentration in traditional assets may not provide the risk management that most people expect from their portfolios. Ray Dalio and other macro investors have consistently emphasized that the goal is not to achieve maximum returns in order to preserve purchasing power across different economic environments while participating in long-term wealth creation, based on historical patterns and current mathematical relationships. This suggests that truly diversified portfolios should include some assets that do not depend entirely on the continued stability of current monetary arrangements. The specific implementation will vary based on individual circumstances, risk tolerance, and time horizon. But the principle is consistent. Concentration in any single system creates vulnerability that can be reduced through appropriate preparation. History suggests that those who understand these principles and implement them systematically tend to preserve and grow their wealth through major transitions. Those who don't often discover too late that their definition of safety was actually their greatest risk. The choice, as always, remains individual. But the mathematics of concentration, risk, and the historical patterns of monetary transitions provide a framework for making that choice intelligently rather than accidentally. This content is for educational and analytical purposes only and should not be considered as specific investment advice. All investment decisions should be made in consultation with qualified financial professionals who can assess individual circumstances and risk tolerance.